What's up everybody, Devin here. In this video today, we are going to talk about how to build a policy built for infinite banking. Now, infinite banking is a concept, it's not a product, but you need a product to use the concept. The concept is best used with a whole life insurance policy. Now, it's not your off-the-shelf policy, it is built for cash value, not built for the death benefit. So in today's video, I'm going to show you exactly how we structure those to make sure that you can get the most out of the policy when it comes to banking. If you have not subscribed to my channel, please do so. Hit the bell as well so you can get notified when I put out these videos. It really helps the channel, and let's just jump right into it. All right, so to build a policy built for infinite banking, you have to understand there's two parts of a policy. There's a base premium. Base premium is regular whole life insurance. It's what most people think. Base premium does not create cash value quickly. It's you put money in and you gotta wait years and years and years before you have any cash value. That's regular whole life. Base premium is what basically gets you the death benefit. The higher your base premium, the higher your death benefit. The base premium is also where the agent makes most of their commission. So most agents, they want to build a policy that is 100% base premium because they're going to get paid more commission, right? However, when it's built that way, there's no cash value for the first several years, which is not good for banking. So you've got your base premium, and then you have what's called paid up additions, or PUAs. Think of those as you're overfunding the base premium. That's what gets you all the cash value. Now, there's a caveat because you can only do that so much. You can't have like a $10 a year base premium and be putting in like $100,000 in paid up additions. It'll just be too much and the policy will become taxable, which you do not want. You want your policy to stay tax-free so that it grows without being taxed. You can use it without being taxed. So there's a fine line, and you have to be able to ride that line between where it's too much overfunding and not enough. So we understand there's two parts of a contract. There's a base premium and there's a paid up additions. Now, we also understand you cannot put too much paid up additions on top of a base premium without it becoming taxable. So what you have to do is look at it as a split. Now, a lot of people will do like 10% base premium, 90% paid up additions. So let's say $10,000 a year, that would be $1,000 on the base and $9,000 in paid up additions. That would be the most that you can do. 10% base, 90% paid up additions. I, however, don't like that design because if you have that much paid up additions on your policy, you have to have a term insurance included to make sure that it's not taxable. Think of it like this. The more paid up additions you put on a policy, the higher the death benefit has to be in order for it to stay non-taxable. So if you've got 90% of your premiums in paid up additions, cash value, then 10% is your base. You've got to have more death benefit. Base is the death benefit. That's what pays for it. So if you've only got 10% base, you don't have a big death benefit. You've got too much paid up additions going on to that small death benefit. So to offset it, to make sure it doesn't become taxable, you have to put a term insurance on the policy. What does that mean? Higher death benefit, but higher cost. It's an extra cost on the policy. Think of the policy like a car. You've got a really, really fast car, but if you've got a whole bunch of weight on that car, it's not going to perform as well. It's the same thing with a policy. You want your policy to be efficient. You want it to weigh as little as possible, so you don't want to have a whole bunch of costs involved. A term insurance on a policy is just extra weight. It's extra lag. If you can get around having that term insurance on the policy, you make the policy more efficient. So personally, the design that I like the best is 30% base, 70% paid up additions. Generally speaking, 30% on base will give you a high enough death benefit when putting 70% onto the paid up additions that you're not going to become taxable. You don't need the term insurance included. So it makes the policy more efficient. And here's the one thing. When you're doing these policies, again, you can only put so much in before it becomes taxable. So let's say you start a policy, 10 grand a year, you've got 30% on the base, so 3,000, and then 70% on the paid up additions, 7,000. Now, that means you're putting in 10 grand a year. If you have more money that's coming in that you can put into a policy, you can't put it on that one policy. You've got to start another one. The benefit to not having a whole bunch of term insurance is that your death benefit is not really, really high. So you can get approved for multiple policies. The problem when you do a really low base, like 10%, 15%, you have to have that term insurance, which boosts the death benefit. And if you go to get another policy, you might not qualify because the insurance company, they might look at it and say, you know what, you've already got enough death benefit. We're not going to approve you for another policy. So you can't put more money into your banking system. Now, sometimes we cannot get around having a term insurance on a policy. Reason being is we just need it sometimes based on age, based on health. Sometimes people they want the most cash value possible. They're not worried about getting additional policies in the future. So they want a really low base premium and a really high paid up addition. So if there's a term rider on the policy, what we do is we have it fall off after 7 to 10 years, really at the max. Reason for that is because first 7 to 10 years, what we're trying to do is front load the policy, put as much paid up additions in as we can, because the more you put in early on in your life, the longer that money has to grow. And the more you put in, the more you can use. So we're trying to front load it all to the front of your policy, the younger you are, so that it has longer to grow and you can use more of it. So for 7 to 10 years, we're trying to max out those paid up additions. Once you get to a point where you cannot put any more in without it becoming taxable, that's the main thing. You want to make sure your policy stays non-taxed. So we're putting as much as we can in for the first 7 to 10 years. That requires, in some cases, a term rider, boosting the death benefit. 7 to 10 years goes by, we can't put any more paid up additions into the policy. So there's no need to have the boosted death benefit. Because if you kept the term insurance on there, it's just additional costs. So what we tend to do is if we need to have a term insurance on the policy, we have it fall off at 7 to 10 years. So the best design, in my opinion, is having about 30% to the base, 70% to the paid up additions. A lot of times that does not require a term rider. If it's less than 30% to base and more towards the paid up additions, generally speaking, you have to have a term rider. If the term rider has to be on there to keep the policy from being taxable, we just have it fall off in 7 to 10 years. Now, there's no one size fits all. Really what this comes down to is what you're trying to use the policy for. The great thing is, me and my team, this is what we specialize in. We only set up policies built for infinite banking. So high cash value, we focus on the cash value, not the death benefit. So truth be told, we're actually lowering our commissions to give you more cash value so that you can become the bank in your own life. It's not about making a big commission check. It's about helping more people. The more people we help, the more money we make. So hopefully that all makes sense. And hopefully this kind of clears up for you if you've been wondering, like, how does a policy get structured? You probably hear it a lot. Specifically designed whole life insurance, specially designed and engineered. You hear it all the time, but a lot of people don't explain what that means. So hopefully this video gave you some clarification. And if you got value, click the like button, shoot your comments as well, any questions you may have, and share this video with other people that might be thinking the same thing. If you guys are ready to start your own policy, there is a link in the description. If you click on the link, you can register for a free training video that I've put out that'll show you from start to finish how a policy can be used to pay off debt faster than you ever could before, how to buy all your cars, get all the money back for cars, for boats, for houses, how to multiply your money using infinite banking. And then at the end of that video, you can actually schedule a call with someone on my team, and we can answer all your questions and help get you started with a policy if you are ready to do so. So until next time, I hope you guys got value. Love you guys. Peace.